12 months ago, Britain was much closer to a financial crisis than most people understood. Inflation had jumped into double digits, rising above 11%. Mortgage payments suddenly became much higher as fixed-rate deals ended. Government borrowing became more expensive. The difference between British and German bond yields grew wider, showing that markets were nervous. The pound looked weak. At one point, experts openly questioned whether the UK was losing trust in global markets. For a G7 economy and America's closest strategic partner, that was shocking. Britain is not a small or weak country. It is the world's sixth largest economy, a nuclear power, a permanent member of the UN Security Council, and a key part of the Western alliance. When confidence in Britain shakes, it sends warning signals far beyond London. And yet, if we look at today, something quiet but important has changed. The UK economy suddenly looks okay, not booming, not leading the world, but stable. And in today's fragile global environment, stability itself is a form of power. For years, the main story around Britain was decline. Since the global financial crisis, economic growth stayed behind the United States. Productivity barely improved. Brexit created years of uncertainty that made businesses afraid to invest for the long term. Then came the pandemic, followed by an inflation shock that hit the UK harder and lasted longer than in many similar countries. Energy prices jumped. Food prices rose fast. Real wages dropped. At one point, more than half of British households said they were cutting their spending. Consumer confidence fell to record lows. Investors responded. Borrowing costs increased quickly. The UK's financial credibility was questioned after policy mistakes shook the markets. In financial centres from New York to Singapore, one belief became stronger. Britain was deeply weakened. But here is what many people missed. Beneath all the negativity, British households were adjusting. They were cutting back. The savings rate rose into double digits, a level usually seen during recessions. People delayed buying big items. They postponed upgrades. They built financial safety cushions. That careful behavior slowed short-term growth, but it made household finances stronger. Household debt compared to the size of the economy has fallen clearly from recent highs. Compared to past cycles, consumers are now less financially stretched. And that matters, because economies rarely recover when households are buried in too much debt. They recover when households have room to spend. Now, add another change. Inflation is still above the Bank of England's 2% target, but it has fallen sharply from its peak. Many experts expect it to slow down even more in the coming months. Interest rates are no longer rising as fast as they did before. Markets now expect slow rate cuts over time. Real incomes are becoming stable. Wage growth is not huge, but compared to the worst part of the inflation crisis, people are earning more in real terms, and this is where the psychological shift begins. When households stop fearing that tomorrow will be worse than today, their behavior changes. Spending starts again. Retail sales have recently been stronger than expected. Monthly GDP numbers have surprised on the upside. Business activity surveys have reached their highest levels in months. None of these numbers alone mean the economy is booming. But direction matters. Momentum matters. Economic recoveries often start quietly before people fully notice them. Here's the first big question. What happens if the UK sees a shared return of confidence, where households, businesses, and investors all relax their defensive mindset at the same time? Because when confidence returns together, growth can rise faster than experts predict. But consumer spending is only part of the story. The deeper structural problem in the British economy has never been short-term ups and downs. The real problem was long-term underinvestment. For decades, the UK invested a smaller share of its national income than many similar advanced economies. After the 2008 financial crisis, productivity growth almost stopped. Output per hour worked, the true measure of economic efficiency, barely increased for years. That explains why wage growth was weak, why living standards felt stuck, and why the UK slowly fell behind some European countries in productivity rankings. But over the past 18 months, something has started to change. Investment data shows steady growth in private sector spending. Businesses seem more willing to commit to long-term projects. Company surveys show improving confidence, and infrastructure plans are moving forward under Prime Minister Keir Starmer. Foreign investment announcements have increased in key sectors like technology, advanced manufacturing, and green energy. Productivity growth is still modest, but it is improving compared to the years after the financial crisis. That may sound small, but small gains in productivity grow stronger over time. And productivity is not just an economic number. It is the base of national strength. It shapes how fast wages can rise, how much tax revenue is available for public services and defense, how much innovation a country can create, and whether it stays competitive in high-value industries. If productivity improves even moderately, Britain does not just stabilize, it strengthens its position inside the Western alliance. Now, step back and look at the bigger picture. For American investors and policymakers, this shift matters. The United States, under President Donald Trump, remains the main growth engine among advanced economies, but it is running very large budget deficits. Germany, long seen as Europe's industrial leader, has struggled with weak growth. France faces its own budget pressures. If the UK becomes the most stable large economy in Europe, global capital will adjust. Investors move money towards stability and trusted institutions. A stable Britain attracts investment that might otherwise go elsewhere. That strengthens London's role as a global financial centre, deepens economic ties with the United States, and reinforces the Western Bloc during a time of rising global competition. This is bigger than small changes in quarterly GDP. It is about the structure of Western economic power. Still, this recovery is fragile. Public debt is high by historical standards, and paying interest on that debt is expensive in today's rate environment. An aging population continues to limit long-term growth. Global trade is becoming more divided as supply chains shift due to strategic rivalry. Energy markets remain exposed to sudden shocks. The UK's financial position is calmer than during the market turmoil under former Prime Minister Liz Truss, but it is not completely secure. This raises the second big question. Is this stability a real turning point, or just a short-term rebound driven by temporary relief? Confidence is powerful, but it is fragile. Consumer confidence can return slowly, yet disappear quickly if inflation rises again or unemployment increases. Business investment can grow, but it can freeze if policy uncertainty returns. Financial markets can remain stable, but they can quickly change their view if trust in government finances weakens. In simple terms, the UK economy is at a critical moment. The pieces for recovery are there: stronger household finances, slowing inflation, rising investment, improving productivity data, and more stable financial markets. But the outcome is not guaranteed. If Britain builds on these gains, if productivity keeps rising, if investment deepens, if fiscal discipline holds, the country could re-establish itself as one of Europe's most dynamic major economies. That would matter not just for British households, but for the broader Western alliance. In a world where economic strength shapes geopolitical influence, a stable and growing UK increases the collective power of the transatlantic bloc. But if momentum weakens, if inflation stays high, if global shocks hit, if confidence falls, this period may later be remembered as only a short calm before renewed pressure. For now, the UK economy looks all right. That alone is a major change from the crisis narrative of recent years. But this is not a celebration. It is a test. The next 2 years will decide whether Britain turns stability into lasting growth or slips back into stagnation. In today's geopolitical landscape, economic resilience is strategic power. What happens next in the UK will shape not only domestic prosperity, but also the balance of power inside the Western world.